Okay, now it's going to be working. That was bad stuff. Should work now. Should be a new link, though. Let's see. We're going to give it about a minute or two for the people to find their way back in. This is obviously a new link, unfortunately. Give me 1 second. Give me 1 sec. Okay. Had some faulty info there, but that's okay. All right, so let's go ahead. We're just going to go ahead and get started. As people come in, they can come in. First off, like a dum-dum, I deleted the slides that I had built about 13 to 14 minutes ago, trying to delete a duplicate copy. And so we're going to somewhat wing this. By winging it, I mean, generally I know what we're going to be talking about, but instead of slides, we're going to be doing it through charts and the actual programs themselves. So it's going to take probably about an hour. Normally what we run is a 45-minute, I yell at you at the top of my lungs, the most important charts. Instead, what we're going to do is we're going to focus on building out the charts themselves. And so we can get a general idea of the end goal here being, what can we reasonably expect over the next 6 to 8 weeks going in towards Q1 of 2024? It's important to understand the way that we run these monthly charting sessions is we generally build our macro thesis around the higher time frame charts, weekly, monthly, and then zoom down into the daily. For those of you that are either inside of TTI or were able to watch the November 1st monthly charting session, because that one was the last public one that we put out, the entire market has flipped from there. We were changing regimes into a potential uptrend. You remember the November monthly charting session, we were talking about going long Microsoft, Meta, some of the Magnificent Seven stocks, etc.
Yeah,
Steve. Anyway, muted Discord. We were going long Mag 7. We were getting exposure to the long side, etc. And now all of a sudden we're starting to see a regime change again. It's still bullish, but it's not in the same spots as it was over the last 6 weeks. So we're going to talk about that, get into it. Hopefully build a game plan out into January, right? We want to be able to start trades now, third week of December, that we're going to be able to hold through a majority of Q1, right? A lot of the trades we're in right now, we opened up at the beginning of November. Here it is halfway through December. We're still in them. And if you've been following any of our content, a lot of these trades are up hundreds and as of now, thousands of percent. We have a couple 1,000% winners for the first time during this tranche of positions. So here we go. It's time to find those new ones. I want to start off though by saying disclaimer, since this is a public video and you are not actively paying me, you don't get to hear me scream at you all day. Don't be stupid. Don't risk more than you can lose. And please do not misconstrue anything we say today as buy or sell recommendations. This is simply technical analysis and our view on what we can reasonably expect over the next 6 to 8 weeks. But please don't buy just because we say we like something. So let's go ahead and start. First thing I want to do is start off with actually some non-charts, right? Or at least charts based off of the browser here. I want to go through the NAAIM number. And if you don't know what this is, essentially it's a survey of CTAs telling us how exposed are they to the current market, right? And if we went back to November, you can see that we were at historic lows. The October 25th number, right as the market was bottoming on the 27th of October and in through Halloween, that was really when we started to see the market find a bottom and start push up. We were at damn near 2-year lows with CTA positioning. That means that a lot of the professional money managers did not have their money in the market at all. Does it surprise you to see that some of the largest money managers did not have their clients' money allocated properly? Does that surprise you? Well, if you've been doing this for long enough, probably not. The CTAs are generally going to be quote unquote, at least in my opinion, some of the slower money, we won't say dumb money, but slower money, right? They have to play by rules that maybe discretionary and retail traders don't have to. So they were caught off sides into the pop. But what have we seen since then? Well, the market is damn near at all-time highs, and we're going to see in a sec, some of the indexes already are. We've now shifted back up towards around 80% of clients' money is now being vested, but we're still not up there near the June or July highs. We still have room to go, which is crazy to think about. If you think about this from the grand scheme of things, imagine yourself as a CTA, you run a fund, you have a bunch of customers' money, and the indexes are about to hit all-time highs. The Dow Jones Industrial Average is at an all-time high. The Qs are less than 1% away. SPY's less than 1.5% away. A lot of mega cap tech stocks are at all-time highs, etc. Imagine telling a client, well, we actually are sitting on the sidelines with your cash and you're not actually getting any of this. As a matter of fact, you might actually be locked up in 5%, some sort of monetary fund, right? That's a surefire way to lose a client. And so what we're seeing and what we've seen over the last few weeks is CTAs rushing to get long at higher prices just simply because clients aren't going to stick around if you told them that into all-time highs, their money is not allocated properly. So they're rushing to get long. And we can see that, right? This is obviously a survey that comes out every 2 weeks or so. And we can see that the S&P 500 obviously pushing up near all-time highs. So as price moves, isn't it funny that sentiment also moves? It's always funny how sentiment tends to change. Price, tends to change sentiment. And as we can reasonably expect, CTAs are chasing this price action long. We were just talking about money, right? Money market funds, etc. So there's a great number going around right now that there's upwards of $9 trillion sitting in these money market funds locked up at 5% per year, and they're going to be unlocked. It's going to be unlocked very soon. Here it is, the retail money market fund sitting at nearly 1.7 trillion. It's a record high. So retail traders as well as financial institutions and large fund managers have locked up $9 trillion worth of cash into 5% yielding money market funds. It's about to be unlocked. Where does that money go? Do you think it's not going to go into stocks? Do you think it's not going to flow throughout the market? Now, where it goes within the market is up for debate, which is what we're going to try to figure out here. But if you think that $9 trillion is simply going to unlock and then not be vested because we're at all-time highs, you're crazy. It absolutely will be. And by the way, a topic we're going to talk about later today, opportunity cost. Imagine yourself at the beginning of the year locking your cash up for 5% because you expected a recession in a very deep bear market that was apparently had to be deeper than last year's. It wasn't good enough that a majority of the mega caps, the Mag 7 were down 50-60%. That was not enough, right? We need more. And so they locked their cash up, and here they are. We're staring at the Qs, which actually might post a top 3 best year-to-date performance ever. And there's $9 trillion that did not participate in this. So what do you think is going to happen, right? Just follow the logic here. What happens when that comes out? We're going to look at the Commitment of Traders report. If you've never looked at anything like this, it's not the most fun thing to read. Shout out Jason Shapiro at Crowded Market Report, CMR, I believe it is. He quantifies this and packages it into some nice images, but we're just going to look at the raw data here. And the only thing I really want to point out is that this data is going back to December 5th, and obviously that's about 10 days ago. And so this could be slightly different in the upcoming report. But if we look at it, even into last week, we still had a huge amount of levered funds, which essentially we can assume is stupid money. It's the short-term speculators, it's the hedge funds, it's the retail traders, etc. Levered long. They were net short, not levered long. Levered short. They were still net short. Asset manager, institutionals, etc. were looking to buy the dip and get long, whereas short-term speculators were looking to continue to short the pop. That's a lot of money that we're probably seeing squeezed right now. A lot of people are covering shorts. As a matter of fact, JP Morgan and Goldman Sachs both came out and said a majority of their clients are not buying here. They're closing their shorts, which means they're still not long. It's insane to think about. This could have been just the beginning of a bigger move, which we actually think it is. Commitment of Traders report shows that there's still a lot of money yet to be thrown into the long side. So everybody's freaking out. How much more can this thing go? Well, probably a lot more. It absolutely has the opportunity to go a lot more. Right, we're going to talk about one of my favorite follows, Steven Straza, on his the old tweeter here. He says at 44%, the percentage of stocks that are overbought in the S&P 500 is at its highest level on record. 44% of the stocks in the S&P 500 are overbought. Only other readings were in June 2003 and June 2020, and he very neatly posted a chart here, and you can see where that actually ended up going. Where did the market go after those overbought periods were identified? Did it go up or did it go down? Well, if you're a 5-year-old, you can probably discern direction. They go up. And I don't care what anybody says in the grand scheme of things. If you're using your RSI or anything you want, overbought is good. And overbought can last quarters. Quarters. The most bullish thing a market can do is hit overbought and stay overbought. Anybody know who said that? Mr. John Bollinger himself. Bollinger Band's creator. Overbought scenarios and environments in the market from a long-term perspective is very bullish. All right. So regardless of what you think about the RSI, conditions can remain overbought for quarters. And we're looking at that right now. So now let's actually come back into TradingView for a second. And I want to show you guys something. There's two ratios that I want you to look at really quick because this is really setting the stage here. If you're in TTI, you know what we're talking about. So we're going to look at a simple ratio, the consumer discretionary space against the consumer staples space. Now, what is this actually showing us? Follow the logic here. Your consumer discretionary names, XLY. Think about if you have a shit ton of money sitting in the bank and you don't know what to do with it, what do? You go spend it on Amazon, you go buy a Tesla or whatever car you want. Doesn't have to be a Tesla. You go and you buy Starbucks, and it's whatever you want to spend your money on that you're not absolutely worried you're about to lose. All of the fun stuff. And then you have your consumer staples, where even during a recession or if you don't have a lot of money, you're still buying it, right? Coca-Cola, doesn't matter how poor you are, you're buying Coca-Cola. Walmart, doesn't matter how poor you are, you're buying those price rollbacks at Walmart, right? You're buying the low-priced retailers, you're buying stuff like that. So a basic intermarket relationship that you can utilize when you're trying to discern whether or not we're bearish or bullish or whatever is simply dividing consumer discretionary against consumer staples. Within this relationship, and I hope you guys remember this forever, uptrends are bullish when it's XLY divided by XLP. Downtrends are bearish. Why? What we're doing is we're taking the absolute performance of XLY and dividing it by the absolute performance of XLP. And when XLY, your consumer discretionary names, are outperforming consumer staples, is it reasonable to assume there is a risk on in the market? Is it reasonable to assume that if you're in a bull market, it's healthy and strong? Yes, absolutely. You expect stocks within the consumer discretionary space to lead the more defensive consumer staples in a bull market. And what are we seeing back at the end of November, or end of October right here? We were saying, listen, and right there you can see it at the bottom, October 25th, October 26th. If this was going to be a new low in the market, you would want this ratio breaking down. And we were starting to bounce off of this previous level of contention. Now remember, there's no supply and demand on this chart. It's simply trend. But we can discern whether or not things are looking like they're changing direction. That's all we really care about with ratio charts is just direction. Did it look like we were going to change direction if we had started bouncing here? No. For whatever reason, this market deems this specific ratio point important. And we started to bounce. And so we had taken note that if you were bearish, you wanted this to break the 2.2 area and start heading down, and we didn't, which is part of the reason, one of the smaller reasons why we started to get long back then. But here we are hitting new highs. So once again, for everybody sitting here worrying that the market is going to shit itself, this very common intermarket relationship is telling us no. Let's go to the next intermarket relationship that I think is probably the most important of all of them right now, because it's pretty fucking obvious we're in a bull market. Do I have to convince anybody? If you still think we're in a bear market rally, I pray for you. I really do. You probably wear knee pads and wrist guards around, so when you trip on things, you don't fucking hurt yourself. We're in a bull market. Indexers near all-time highs. You just got to deal with it. SPHB is your high beta ETF, right? This specific ETF owns the highest beta stocks that it can within the S&P 500. Beta meaning volatility, high volatility names. SPLV, low volatility ETF. This is the S&P 500 low volatility ETF. What do you think we're going to do? We're going to take the SPHB and divide it by the SPLV. What is that going to do? It's going to give us a ratio chart of high beta stocks against low beta stocks. What do you expect a range break going back 3 years means in terms of high beta stocks? What do you expect? This is telling us right now that if you had the opportunity, and we're going to go through this specific trade idea later, because this point right here is going to make you, in my mind, the most money out of any specific trade idea, this concept. Now is the time to be pressing risk into higher beta stocks, not lower volatility stocks. We're going to touch on that later because there are sectors breaking out that are notorious for lower beta, lower volatility names. But the market is telling you right now is the time to buy higher beta. And by the way, just so everyone's fully aware, if you are a trader, you have to make the conscious decision every time about where you're going to lock up your precious finite capital. Not everybody here is sitting on $1 billion fucking dollars. Most of us have 4, 5, 6, potentially 7-figure accounts. We have to make that decision because what happens if we get into a trade that nets us 15% over a month, and that's great, but we had the opportunity to own something with more or less the same amount of risk that can move 50%. What's the better opportunity? What's the higher expected value? We're going to talk about this later, but this right here, ratio telling us you got to be pressing risk into higher beta stocks over lower beta stocks. So let's look at the indexes really quick. We were just talking about, we're up near all-time highs in some of these, right? Let's go to the weekly first because, hello, this is the mid-monthly charting session and we don't just look at everything on the daily. How close are we? If you're new to trading, you don't know what a line chart is. They only chart the close. It's fantastic. From a swing trading perspective, you don't need to know highs and lows. Really, you don't even need to know the fucking open. All you need to know is the close. There's an old adage in swing trading, the close knows. Pretty stupid, but it makes sense. We are batting for the overnight moves. That's where we make our money. So where the stock closes is more important to us than where it hits intraday. It doesn't matter. So if you, for example, have a problem cutting through the noise intraday because the candlesticks can confuse you, or just put it to a goddamn line chart and look at the direction and trade the direction. It really can be that simple. I'm not saying it's easy, but it's simple. Right now, SPY sitting at 472 on the close. Shift click up. We are within 1% away from a close all-time high S&P 500. You can see kind of how we were expecting to play this on the weekly. I'm going to bring it down to the daily so you can really get a general idea of the way that we looked at SPY. Right? Obviously, we were looking to buy at the beginning of November, end of October, this area right here. I want to point something out. It's a little bit harder to see these divergences that we have on some of these charts. If you don't know what a divergence is, I'm not going to take the time to explain it, but these can be very powerful front-running types of environments. Now, they don't always play out in a timely fashion, so divergences can last weeks, months, quarters, years, depending on the time frame, but they essentially are telling us, right, as price hits lower lows, momentum is waning into those lows, meaning that selling pressure it's losing steam, if you will. Each new low is accompanied by less momentum to the downside, giving you a little bit higher probability that there's going to be a reversal somewhere. So we keyed in on this. There's a couple charts here that all had this bullish divergence where RSI failed to hit new lows, but price did. And we go, hey, there's probably going to be a pivot somewhere. We didn't know exactly where it was going to be. This was step one of like 70 steps we took before we really started getting long, heavy at the beginning of November, but it's there. So you can start to plan. You can start to set expectations. Maybe each new low, let's look and see, is there enough evidence here to potentially start buying the dip without actually blowing an account? Because be honest with you, Paul Tudor Jones famously said, nothing good happens below the 200-day moving average, and SPY was below the 200-day moving average. And he also notoriously said, losers average losers. Don't blow an account DCAing down if you're a trader. Long-term investing is completely different. Here we are staring the S&P 500 less than 1% away from an all-time high close. If you're bearish, like I said, I don't know if you're in the right market here. I don't know if what you're doing is connected with reality. The Qs are even closer, right? And this makes total sense, by the way. Over the last 13 to 14 years, NASDAQ has outperformed SPY every single time we're in an uptrend, bull market type of environment. But I will say, if you go back to post.com, financials, energy, etc., outperform tech. So yes, the environment's a little different here. Software companies are a lot different than they were post.com bubble, but there can be extended periods of time where value companies do outperform in a bull market. It has happened within our lifetimes. We might not have traded it, but it has happened. As of right now, though, the Qs are taking a commanding role. And how awkward is it that Mag 7 is not responding well, but the Qs are? Isn't that great? It's fantastic for new opportunities. Qs right now is literally within a stone's throw of closing at all-time highs, like 0.5%. It's so incredibly awesome to be long in this type of environment. It's so incredibly awesome to be long this type of environment. Look at the RSI screaming at us that this is a bullish momentum regime, and there's really no reason not to continue to be pressing risk long at strategic locations. We're about to hit the period in the market where you got to push the fucking pedal down to the metal, as we're going to see in a little bit here with the IWM charts, etc. This is the time to be pressing risk. A lot of people are going to sit here and they're going to be afraid to own all-time highs because they've been indoctrinated over the last year and a half that the market's a scam, the recession's coming, fuck all of the noise. There's no more bullish opportunity than at all-time highs, because you want to know what comes before all-time highs? A previous all-time high. That's how trends work. If we're breaking out, all you got to do, if you don't believe me, go back to last time we hit new highs, shift click up. How much did we run? Shift click up. How much did we run? Right? It doesn't have to be any harder than that. Look at what happens near all-time highs on the indexes. They tend to continue to go up a lot. Okay, so this is an opportunity for you if you find yourself underpositioned, looking for positions. Use the all-time highs as a gauging point on where you can potentially get long. The Qs, once again, very, very close. Will probably be there. I thought we were going to get there by like the first or second week of January, and the market gave me the middle finger and said we're going to be there potentially in the middle of December. I mean, we're right there. We're going to look at the Dow in a second. What I want to switch over to really quick is COIFIN, and I just want to look at sector performance. Start to build out, this is kind of what makes TTI special. We look at sector performance, industry performance, market cap performance, and we build a game plan based off of where in the market are funds buying based off of sector and industries and market caps. This is one of the greatest edges you can ever have as a swing trader. Absolutely. If there's anything that you can learn from me, it's go look at your sectors and industries. Just do it and look at how they move, because you can get a bird's eye view on which sectors are moving, which industry groups are moving. This is like Stan Weinstein 101. Bulkowski quantified this. This goes all the way back to Richard Wyckoff 120 years ago. If you can key in on which industries and sectors the market wants to own, you can go find the individual winners within those. But this is a great way to dumb it down. Instead of looking at 8,000 potential stocks to buy, we can look at, I don't know how many there are, 8 to 12 here, and then we can really key down. Going back to the October 13th lows in 2022, all right, that's when the market bottomed last year. Tech has outperformed. If you're in a bull market, that's probably where you're going to be outperforming over the last 13 years. Tech generally takes the lead, and nothing has changed here. That's the reason why inside of TTI, we're still very, very long tech names. We'll go through the industry groups in a little bit, but there's no reason to think tech is going to stop. It will eventually, but the opportunity cost of trying to time the top is going to be very expensive if it doesn't stop. Communications up second most, which is kind of surprising, right? Most people would expect consumer discretionary, your Amazons, your Teslas, but actually they've underperformed SPY going back to the October 13th bottom. So yeah, everybody that loves Tesla so much, totally get it, but it's actually underperforming the market index. Tech has absolutely destroyed everything. A lot of that is NVIDIA, but a lot of it is also Apple and Microsoft. Apple and Microsoft being the two biggest holdings within XOK. So Tesla, Amazon kind of holding back a little bit of the underperformers there. Communications, Meta, and Google popping up. Those are the two big ones in comms. And look at XLI. This is an area of the market that I don't think anybody is really looking at yet. A couple people on Twitter are talking about it, but we're gonna look at XLI, because XLI is now outperforming SPY, and I guarantee you, if we flip over to the 3-month, it's going to be up relatively large. And there we go. I wasn't originally going to do this, but if we take off, there it is. So last 3 months, look at what is leading now. Real estate just leapfrog tech. It's a harder name to get long. Those stocks generally don't have a lot of options volume, but still, if you're trading shares, there's some good opportunities. Tech is still obviously up there. You don't want to close those. Look at your financials and industrials, though, right? These are sector groups that have not outperformed all year, and now all of a sudden are starting to outperform as we're hitting all-time highs. Maybe it's time to start looking at some of those banks. We're going to go through those in a sec. Maybe it's time to start looking at those industrials. We're going to look at those in a sec. Everybody's so gung-ho on owning the Apples, the Microsofts, and although those are going to perform well, they always do, are they going to perform the best? Is that the highest probability trade right now? Is that the best place to be allocating your scarce capital? We'll see that in a second. Let's go back to TradingView and let's look at XOK on the daily. Let's look at it. All-time high. When we pulled this up, we were just about to break out, as you can see here, of this potential handle, right? This is a massive cup and handle is what we were looking at inside of TTI. We were just at the cusp of breaking out. We took the long. We took the liberty of getting long prior to the actual breakout, and it ran for us, which is great. Semiconductors look very similar, which we'll go through in a second. Is this bearish? Is there anything that screams to you right now there has to be a pullback? Well, if you go back in history and look at the previous times we've broken down to all-time highs, generally these things run for quite a while. They run for quite a while, right? So we like this XLK all-time highs. Overbought conditions can last forever. This is a great sector to be looking at buying new positions. We're obviously long a CrowdStrike trade. This is one of those trades that ended up being a Grand Slam trade that we didn't actually expect, right? So we bought it originally off of the 170 area, both the first breakout and the bounce here. We have a couple guys that are still holding their CrowdStrike trades. Congratulations, Brian, if you're listening to this. He's very close to, I believe it's going to be his first 1,000% winner in CrowdStrike. Very, very close here. But this is a great example of you never know which trade is going to end up being a Grand Slam trade. We got long CrowdStrike in October before everybody else started getting long. We didn't really know if it was going to work out all that well, but it was a leading name within the software space. We took a crack at it, and it did end up working out well. So congrats, Brian, and the rest of the guys in TTI that grabbed it. This is a good example of take the trade if it's available. If it doesn't work, it's cost of doing business, but take it if the setup is there. Don't try to outsmart the market. You're going to, you're not smarter than the market. Nobody is. Just take what the market gives you and then run with it, right? XLC, like I said, the second best performing sector going back to October 13th of last year. We'd asked our TTI members back in, I think it was around the beginning of the month, was this a pullback or a top? We expected it to be a pullback in towards a previous resistance and support. Now, it is important to understand that Google and Meta are not performing as well as the broader sector. That's part of the reason why we're doing this mid-monthly charting session. We're going to look at some names that are not Meta and Google, but we're still long a Meta name. So let's go ahead and pull that up really quick. You can see it. We do have a couple guys in Google. We did buy down here in the middle of the range near 305 with the expectation we were going to break out. We did, but it's a slow moving trade, right? We're expecting near all-time highs in Meta over the next 6 to 8 weeks. So if you're looking to get long Meta, potentially be looking near a 325 area entry, previous resistance now turns support. It's just not a very fast moving trade right now, and I think there's better opportunities. Meta, still, we have a position, so I'm throwing it out there. We are long this specific name. And consumer discretionary, the lagger of the group in terms of the growth sectors, right? We're finally breaking out. Amazon and Tesla not really contributing a whole lot, but some of the industry groups within XLY don't really get any attention, right? You have retail is a massive consumer discretionary industry. What about resorts, hotels, and casinos? What about your Royal Caribbean, your cruise lines? What about, these things matter to consumer discretionary, and now we're starting to break out. This is almost a 2-year high in consumer discretionary without Tesla or Amazon really helping a whole lot. Go and look at your consumer discretionary names, right? This is an opportunity for you to go and look at the names that nobody else is really talking about. You can find some diamonds in the rough and ride them for the next 6, 8, 12, 16 weeks for huge wins. Remember, the names that you're opening up here over the next week or two, you have an opportunity to hold through the March or April expiration. So you're looking for like a 4-month trade here, and you have some great entries. Consumer discretionary finally breaking out into a 2-year high. Now, we are long Amazon. Once again, not a bad trade. It is trending upwards, but it's just underperforming what we expected, right? We bought it off the original 140 pivot, currently trading 147. We have a combination of shares and contracts. It's not a home run trade whatsoever. Can it be? Maybe. We have a lot of time on this play, but it's just underperforming. So we're not going to continue to open these mega cap stocks. If you haven't noticed, we got long Meta, we got long Amazon, or long Microsoft, which I didn't talk about. Some of them are giving us free rides now. We're up and over 100% before pullback. Some of these are just slowly moving, but right now we can definitely tell the indexes are hitting new all-time highs and the mega cap names are not necessarily shoving. So it's almost insanity, like Albert Einstein said. Continuing to do the same thing over and over with no difference in result is insanity. So let's stop doing it. Let's stop opening positions in Amazon, Meta, Microsoft, NVIDIA, all of these names, at least from a trading perspective right now, because there's better opportunities. Right? Let's talk about some of those in a second. Let's talk XLF really quick. There's an opportunity. We just talked about 2-year highs in consumer discretionary. What about financials? We just hit a 2-year high in financials, basically. I'll delete this because we were talking about this at the 3-month high. Look at this. Financials are closer to all-time highs than not. 2-year high in financials. There's some of us are talking about regional banks. We'll talk about that in a second as well. But look at your financials. Does anybody have a trade that they're looking at for financial? I'll tell you what right now. What about JP Morgan? This is the leader of the group. This is the best looking chart of the large cap banks. We're almost at all-time highs. Is anybody talking about JP Morgan? I haven't seen a single person. I tweeted it out a couple days ago. Nice little pivot level we have here at the 144 area. I wouldn't surprise me to see JP Morgan at all-time high within the first week or two of January. Let's talk about UBS. This is a trade that we did take. I'm going to take this into the weekly chart because I want to show you guys something. This is a 15-year base breakout. 15 years. and we bought the 23 break. I think I might be the last soldier standing. I have a $30 contract. It was up 450% today, but I bought this in August. So for those of you that think I can't trade because I don't have enough time, I bought this in August. You just have to set the expectation for the trade and buy yourself enough expiration. That's it. If you think this thing's going to take a while, which I did, it's a 15-year base and it doesn't move very fast, go buy 8 months of expiration. It's going to cost you a little bit, but you can absolutely still maneuver inside of a market with longer dated expirations that don't need a lot of management intraday. You didn't need anything. I haven't touched this thing since I opened it on, I think it was August 11th. Good opportunity here though, or it was for UBS. I'm just trying to showcase here that you can buy things outside of tech, right? Go buy some of those banks. Look at them. There's a lot out there right now that are breaking out. XLI, all-time high. So along with tech right now, industrials are at all-time highs. Now, industrials are kind of a weird sector. They have about 75 industry groups inside, and it's one of those sectors where when a stock gets listed and the market doesn't know where it's going to go, they throw it in industrials, right? You have aerospace and defense, you have railroads and logistics, you have paper companies, right? Like it's just such a random. You have airlines. It's such a random sector that, you know, what we're going to see in a sec is it does look a lot like the Dow Jones Industrial Average because it's very well diversified from a sector standpoint. So here we are at all-time highs, the industrial sector itself. There's a lot of different areas to attack here, right? One of them that we just opened up a few sessions ago, shout out Tom if you're watching this, is Boeing, right? We bought it off of the 240 pivot, currently trading 255, 256. This is probably going to be a little bit slower of a moving trade. I'm going to bring this back down into the daily here because we've been operating on the weekly charts. You can really see there's a nice little pivot level there, coincides with some volume. We're looking to push this thing up towards north of 300 before any real significant resistance. That 268 area is the first time that we're going to be moving stops up and potentially taking a little bit of profit off of this trade because that was the high point on the swing up back in 2020, 2021. But this is a leader group or leader stock, inside of the industrial sector. Now, this is not necessarily the best setup within the space. You can go and find better setups, but this is the first trade in the sector that we wanted to take. It was giving us an entry at the 240 pivot, so we took it. We are looking to gain more exposure in this industrial sector, because at all-time highs, you got to be looking at this sector time and time again. Where are the layup trades? Where are the trades we can take right now that are going to mature over the next 4, 8, 12 weeks that are going to turn into grand slams? It could be Boeing. I have no idea. So let's look really quick at that Mag 7 idea. If you've never used Koyfin, I'm going to show you really quick how to use this. It's a neat little tool. We're just going to build out the Mag 7. So let's start with Tesla, NVIDIA, Apple, Microsoft, Amazon, Meta, and Google. I think that's it, actually. That was 1, 2, 3, 4, 5. So that was easy. So let's go back to the Mag 7. Let's go to year to date here. And let's just look at these really quick. So obviously everybody wants to own these. From a long-term standpoint, I totally get it, right? Long-term, you don't want to get rid of this stuff. But we're not long-term traders, even as swing traders. TTI, we're looking 60, 90, 120 days out, right? 120 days is still technically going to be a short-term trade. It's 3 months. Now, in this current day and age where everybody is addicted to fucking TikTok and short-form reels, and everybody has something to sell you, and you got to look here, no, you got to look there. There's a lot of edge in fucking waiting and having patience. You can outperform a lot of people by simply doing nothing and waiting because people are irrational nowadays. It's unfortunately kind of the flavor in the air. Everybody needs your attention, and it directly hurts your trading performance. Mag 7 right now, is this the best opportunity to be trading? Year-to-date performance, fantastic long-term holds, and we've had some great trades on this, but is it now worth looking at? We go to month to date. Are these the types of moves that we've expected where indexes are hitting all-time highs? Tesla's up 4.5%. That's like 2 days normally. And we're going back month to date. Microsoft is down. Google is down. We have indexes at all-time highs. We have sectors at all-time highs. And the Mag 7 are not responding well. It's, once again, not to say that they're always not going to respond well. But is this the time to be buying this stuff? Well, why don't we go look at the stuff that is performing well right now at all-time highs? There's definitely something going on. There's a little bit of a regime change. So let's look at it really quick. Let's go to the industries instead of sectors. Let's bring it down. And we'll just go to year to date. We don't have to go back to the October. I want to focus on semiconductors, obviously, right? So we're going to talk through a semiconductor play that we're in right now. Home builders, though. Nobody's trading home builders that I know of. It's pretty hard to get long an options trade. We are long 2 home builders right now within TTI, but I'm going to point the chart out because guess what? For decent amount of time, home builders led the market. They were outperforming semiconductors, and here they are again after today. Huge gap up in home builders. Does anybody actually look at home builders in here? It's not a very popular trading group, but here it is screaming at you, fucking buy me. So I'm going to show you two names that we're in. Software, still great. We still love it. It's also going to play into the market cap stuff we're going to talk about in a second. Internet, still nice, right? These are all three of these: semiconductors, software, and internet. These are all tech industries within that tech sector, so it shouldn't surprise you. But you want to know the one industry group that does surprise? Check this out. We want to do 3 month. We'll do 3 month. Check this out. So we've talked about that there is a regime change. There is a regime change going on right now. Mega cap tech stocks are not being rewarded the same that they were. Who had regional banks outperforming in Q4 on their bingo card? We knew it was going to happen eventually. The regional banking crisis back in March destroyed these things, and rightfully so. But at some point, they were going to bounce back when the market finally realized that not all of them were going to die. And here it is. Here it is. So we're going to go through a couple of those as well. And you can go and buy those right now, right? You can go and buy some regional banks right now that are breaking out. Home builders, semiconductors, look at retail, right? So there's a lot of opportunity in the market right now that are not particularly in the Magnificent Seven. So let's go to semiconductors on the daily really quick, just to really drive this home. All-time highs. Does it surprise you that semiconductors are at all-time highs if tech's at all-time highs? Absolutely not. Little caveat here. Old school Dow theory dictates that generally indexes move in the same direction when the market is efficient. So if all of the major indexes are moving up, it's a very efficient bull market. If all of them are moving down, very efficient bear market, trade accordingly. New Dow theory says that the semiconductor industry group itself might be the most important of all of them. Why? Because in today's age, the most valuable companies in the world will be buying semiconductors. And if semiconductors themselves are going up, you can reasonably assume demand is up. And when demand is up, you can reasonably assume we are not in a fucking recession. And the market is not afraid of a recession. Now, this is more so a new, like last few years kind of addition, right? The CMT traders and stuff are kind of talking about viewing it this way. I tend to agree. When semiconductors are being bought in at all-time highs, how bad can the economy really be? It just doesn't make any sense. So here we are with obviously an all-time high in semiconductors. So go look at that, right? We're in this play right now. We're in ARM. This is the NVIDIA IPO spinoff. We're going to take this down to the candlestick so you can see we've added 3 times, or excuse me, we have 3 different positions in this. The 56.5, we bought a pullback at the bottom of the support range here. And then we bought, I did not, but people in TTI bought off of the previous resistance, now turned support bounce as well. This is going to be potentially the biggest trade we take as a group. This is an absolute killer. The first positions are up nearly 1,000%. Second ones are up in between 400 or 500%. And today, the most recent adds up in between 150 and 250. So this has the opportunity to be the biggest trade for us. But it's not just ARM, right? There's other areas within the semiconductor space that are doing reasonably well as well. We have a couple guys that have AMD exposure. It's not just NVIDIA. It's not just NVIDIA. So go find the charts that are giving you horizontal level breakouts or whatever your system dictates and go and buy them. Because semiconductors at all-time highs is not a bad thing. Let's look at home builders. We just saw the big pop up in the home builder strength. Check this out. All-time highs in home builders. Look at the last 2 days. If that's not screaming at you, fucking buy this area. I don't know how else I can convince you. That is a gap and go, right? That is a gap and go on home builders, home construction. Like, go and buy these specific names. By the way, fun little fact here. It might save you a lot of money in the long run. Buy the smiles and sell the frowns. Buy the smiles and sell the frowns. If you're anything into chart patterns and whatever else, what is this? It's a rounded bottom. What generally occurs off of a rounded bottom horizontal level break, a big push to the upside. What happens on a big horizontal level break from a rounding top, a big drawdown, sell the frown, buy the smile, okay? Home builders, we're in BLDR. Nice trade here. Bought it off of the horizontal level pivot, somewhere around the 145 to 150 area. I'm not entirely sure because I'm not in this trade, but here is one of the leading names in the home builder space. Kind of hard to get long now, but who had Builder? Who had Builder off of its previous all-time high in 2020, up 500% over 2 or 3 years? Not me. I have no fucking idea. Remember, when the market was freaking out, or not the market, when everybody was freaking out that a recession was happening, home builders were silently making all-time highs. talking about it on Twitter with some of the brightest minds. They expected real estate market to crash and builders to go down with it. But all year, builders have been hitting all-time highs, and here we are once again. And it's always funny after the fact. People are going to say, well, it's because the Fed. Well, it was the Fed all fucking year, dumb, buy the uptrend. Here's another one that we just entered, AZAC. This one's a little bit easier to get long. You can see the full trade idea by the smile once again. You can see the full trade ID here. An entry above, we just split the chart in half. We like this above 35.5 with a potential price target up near all-time highs. You can see the stop. It's a 4.5 to 1 risk to reward from a share standpoint. If you get some sort of pullback on AZAC, this is not a bad idea to get long something like this. Get a piece of it. Get a piece of a home builder. I encourage you to go scan through those stocks. From an option standpoint, it's going to be a little bit harder to get long because there's not a lot of liquidity. But hey, if you're a shares trader or you don't mind dabbling in both, there is great opportunity in home builders right now. And this is one of those trades, like I said, that could take months to play out. So you can just sit in it and wait as long as you're not being stopped out. Don't be too afraid to hold through consolidation. As you saw, Builder consolidated for a while, and it's just a fucking straight up rocket ship. 500+% in the last 2 to 3 years. Software, almost 2-year highs. I believe we're pretty goddamn close now. We are basically at 2-year highs, not all-time highs. Software names. Software is not just Microsoft, right? It's a lot of different groups. CrowdStrike, obviously a trade that we're in. We were just talking about that. But we're also in PanW, software-related name. How can you hate this? Buy the smile. All-time highs, right? PanW ended up being a very close to 1,000% winner. This is a free trade, so we're just going to let it sit on the books. We still have about 3 months left, 4 months left of expiration. I think we grabbed those Marches. This could be a grand slam. It is a grand slam trade. We'll see if it continues to be. Today was a particularly nasty pullback, bearish engulfing here. You're going to see a lot of those mega cap tech stocks. This is not mega cap, but this is one of the large cap cybersecurity software names. A lot of them posted some bearish engulfings. Not a great look. Now, if you want to know why, I could tell you why FinTwit thinks the index rebalancing. So they're obviously selling off some of the larger positions to meet their requirements. Why I think I don't give a shit. I just don't care. As long as we're in an uptrend, I'm going to continue to hold it. I don't need to know why something is happening. I just need to react to the spots on the chart that matter to me. PanW pulling back today, though. Fantastic trade. All-time highs today, PanW. We'll see how it does over the next few sessions. But once again, this is a good example of you don't need to own Microsoft if you want to own a software name. Go own Palo Alto. Go deep dive the software industry itself. You can do that on FinViz. It takes 3 seconds. Look for strength. Average volume over 1 million shares per 30 days. Look at 50-day highs. Bring it into the software. Make sure your optionable and shortable is on if you're an options trader. And go pick out the best looking charts and buy them. It doesn't have to be any harder than that. Let's look at the internet area. This is also a pretty diverse group, right? We have things like Adobe, and we have other names that don't make any friggin' sense. Like we have some social Snapchat and stuff exposure, stuff like that. So it's just a kind of a random industry group within tech. But here we are once again pressing up in near 2-year highs. So tech across the board, all industry groups up. And we can look at something as simple as like a Coinbase trade, right? This is a trade that we've taken 3 times this year. Most recent ad was at the 110 pivot. We're very, very close to taking some profit at the 155, 158 area. Awesome trade. Very, very good opportunity here on Coin. We can once again re-enter, re-add, whatever you want to do at near the 158, 160 area. I would look for Coin for some consolidation around 160. Previous support turned into resistance. Nice fib level here. Every asshole in the world, including us, is using this specific fib extension to take profit. So it's reasonable to assume at the 158 to 160 area, there's going to be some consolidation. If you're looking to get long Coin, there's not a bad idea to get long around that area. Run a stop underneath 160 by a couple percent and look for the 200 move. Post 200 up towards 205, follow the fibs up, 4.236 at 236, etc. Right? Great opportunity here on Coin. We don't think it's going to stop anytime soon. We will be looking to roll this position out. Big winner for us so far. Could potentially be a big winner for you if you like it off of the 158, 160 pivot. Let's look at my favorite industry group right now, the regional banks. Right? Nobody wanted to own regional banks for a while. Totally understand why. This was a particularly nasty fallback back in March. Regional bank crisis, right? Took forever for the market to really start liking this stuff. It was not an easy grind. We tried to take a couple stabs at names like Zion. This worked out reasonably well. At the very minimum, it gave us a 100% winner off of the first pop, but then we faded. So I still have some contracts on there that are free. As a matter of fact, I'm green again on them. There was no risk at my account capital, but here we are double gapping up on Zion. We have another trade that we just opened up a few sessions ago on CUBI as a shares trade. Originally liked it above 46.5, missed it. Grabbed it at 48.50 instead, currently trading 53.84. Not a bad little pop-up in shares, right? Up about 9 to 10%. So for the guys with larger accounts that trade shares, this is one of those regional banks that already has recovered from their March lows. So a lot of crazy strength there. And then the trade that I think most people inside of TTI and probably the people watching the stream are in, Key. Key is just a fantastic example of taking advantage of low volume opportunities. And what do I mean by that? We gapped down. Let's move this. We gapped down from 15 all the way down to about 12.5. And when we were originally looking at all the different regional banks, they all relatively had the same setup. It's an island reversal. That's what it is, right? When you gap down, build a horizontal channel, and then you're looking to break back in the direction against the gap, that is called an island reversal fractal. It can happen at a top, in a downtrend. It can happen at a bottom, and an uptrend. What we like to do, though, is target those gap fills, right? Not all of them are going to be completely gaps, but we can verify using the right-hand side, our VRVP indicator, the volume. And what we noticed with Key, as opposed to some other names, is other names sold off with no gap and had a lot of volume. And then we saw Key where it gapped and had no volume. If you're a technical trader and you have an opportunity to trade a name with a lot of volume overhead or no volume overhead, please believe me, over time, you will perform better buying the motherfucker with no volume overhead. This is a great example why. Regional banks popped today over the last two sessions, really. Key got a head start, which is what we expected. That's why we bought it off the 12.5 pivot. This particular trade for us is up 300 to 400% right now. And we're not even in the money yet. $15 calls that we bought for March. So we still have another 3 months, 4 months to hold these things. We can manage a couple of the contracts at $15. And now we have 3 months left before Theta really starts to kick our ass. That this thing can just do whatever it wants. If it meanders its way up to 17.5, it's just more money for us. We have the opportunity and luxury to hold the fucking trade without worrying about it. That's the best part, right? So we like this specific setup. Little trading tip. If you find an opportunity with no volume overhead, take that one over more or less the same setup that does have volume. It's going to work better, right? So good job on Key for the guys that are in this. Like I said, this was a trade that I posted on Twitter. I sent a newsletter out, so I think a lot of people are in Key. Good job. It's a great opportunity there. A few other things, and then we're going to wrap this up. If you guys have any questions, post them on the YouTube chat, and I'll be able to answer them at the end, but I have a 30-second delay, so get them in now. I'm going to try to finish this within the next 10 minutes, give about 3 to 5 minutes of Q&A. This is where the juicy part comes in. We just set the stage for sectors, industries, some of the trades we're in, areas that you can look at, but I want to show you where we're looking now. Where are the trades that we are going to be opening up now that are going to potentially make us money over the next 6 to 8 weeks into Q4? I'm going to show you a hidden tool here. It's proprietary, all right? Don't copy me. Just kidding. Koifin's the best. You don't own Koifin, go buy it. I have a ref link, but if you don't want to use it, that's fine. This is the best deep analytical tool you can use outside of a Bloomberg terminal, hands down. Factor analysis. We're looking at market cap against SPY. What do you guys notice here? What do you guys notice here? I'll tell you one thing. Large cap growth, if you go to year to date, has outperformed everything, but we're in a relative downtrend now. That's your large cap growth. That's your Microsoft, Apple, Tesla, Amazon, your Mag 7. After peaking in the middle of October against the S&P 500, it has been underperforming. Let's go back to the 3-month. What are we seeing now? We are seeing mid-cap and small-cap outperform large-cap. That's what we're seeing. And that's also why, if you're following on Twitter or watching the previous videos we put out on YouTube over the last 2 weeks, we have been buying things like GitLab. We've been buying things like Sentinel-1. We've been buying things that are small and mid-cap for a reason, because we started to see this trend change. But now it's staring at you in the face with a big middle finger, which we're going to look at in a second when we look at IWM, that if you don't buy this, you will be chasing it next quarter. It's going to fucking happen. I'm telling you right now. Hold me to that. We're seeing it already. Against the S&P 500, small cap value, small cap growth, mid cap value, mid cap growth is outperforming. Go and buy the names that are within that specific space. That's where risk is flowing. So like I said, now we know where we want to be positioning ourselves over the next 6 to 8 weeks. It's not Microsoft, Amazon, and Meta. And I'm not saying that that absolutely has to die. It's not. It's not going to fucking die. If that dies, the market's probably going to die. And we don't think that's going to happen. But it will underperform. Your Russell 2K, 2-year horizontal channel here. Buy the fucking smile. Just buy it. Above $200, this is a 2-year high in the Russell 2K. This is a massive, in our mind, a massive accumulation base, a massive stage 1 Stan Weinstein cycle theory. We think above 200 is the beginning of a markup period into new highs eventually. It's not going to happen overnight. But we were there above 200 today. As a matter of fact, we hit 204 pennies. Unable to close up there, but we are watching this like a hawk. Above 200, we want to be long small and mid caps with size. And that's really the big difference here. We're already long some smalls and mids. But now is the time to be pushing the gas pedal down on risk in smalls and mids. Now is the time. You're going to watch some dickhole say, we should have bought it at the fucking low. What happened the last 50 times you tried buying it at the low? Did that one work out? No. So it's always nice, buy them at the lows. Nobody knows where the exact fucking low is going to be. So buy them as the breaking horizontal channels where you can define your risk easily. You know where you're going to be right. You know where you're going to be wrong on a $200 area breakout because we have hit resistance here 3 different times over the last 2 years. This is your opportunity. Let me show you some historical data to prove the point even more. If you look at over the last 50 years, 1979 to 2023, something like that, 50 years, 40 years, 50 years. This is averaged out. The Russell 2000 divided by the Russell 1000. This is small caps divided by large caps. So once again, remember those ratio charts we were looking at earlier? If this line goes up, that means small caps are outperforming large caps, right? What did we see in the middle of December through the end of February? A massive fucking outperformance of small caps over large caps. It's called the January effect. It happens more often than not. What is the date today? The 14th. What has happened over the last 2 fucking weeks? IWM has outperformed SPY. We're building the case here, right? You have historical data going back 50 years saying that this is a well-known phenomenon and you could generally assume this is going to happen. It's weird if it doesn't. And guess what? It's happening on both a relative basis, a historical basis, and an absolute basis. Inside of TTI, we don't just take one, we want all 3. Absolute and relative both have to be moving in the same direction for us to take a trade. Relative and absolute both have to be moving in the same direction. What do we see? IWM breaking out above a 2-year base and on a relative basis outperforming the S&P 500. Can I make it any fucking clearer? Go buy this shit. So let's look at it really quick. Getting all amped up, man. I love this stuff. It's like a big puzzle. It's so much more fun and profitable when you're not like a 5-year-old finger painting like fucking chart pattern. Oh, I could find a triangle and buy it. Go scan for triangles today. You're going to have 50,000 of them. Which ones are you going to buy? You can't buy them all, asshole. This is where the real money's made. Figuring out the fucking puzzle. Putting some real big boy cash behind this stuff. Let's go to IWM and look at the holdings here. I don't have to convince you anymore that IWM is breaking out. I don't have to convince you anymore that this is probably going to be an opportunity to be throwing cash into the markets. So let's use Koifin once again to get a general idea of, well, if IWM is showing us a 2-year base breakout, and we can already tell on a relative basis it's outperforming the rest of the market caps, what is inside of the Russell 2000 from a sector and industry standpoint? Industrials, financials, healthcare, like 3 areas of the market nobody generally trades. Everyone's so keyed in on tech, consumer discretionary. If IWM is breaking into 2-year highs, it's not because only tech is participating, right? As a matter of fact, it's the 4th largest holding within the small caps. Industrials and financials have a lion's share, over 30%. So if IWM is breaking out, you have to assume industrials and financials are as well. And guess what? At least over the last 3 months, let's see. It's financials. I'm doing this live with you. It's financials. Is that surprising? Let's see. The largest industry group within the Russell 2K are banks. If the Russell 2K is a small/mid cap ETF and banks are the largest industry, can you tell me what type of financials are within IWM? Could it be Key? Could it be CUBI? Could it be the regional banks that we were just looking at? All the shit's interconnected. So now you have a roadmap of what you want to own. Small caps are breaking out. You have higher beta regional banks breaking out. And we understand that regional banks are the largest specific industry group within IWM. Go buy the fucking regional banks. Go buy the stuff that nobody is looking at right now. Go and buy them. Let's look at ARK, because here's another very, very important chart. Everybody wants to shit on Kathy. Totally fine. Don't care about your politics. I do care about stage 2 breakouts, though. This is yet again a stage 2 breakout after a 2-year base. Look at this. This is fucking Stan Weinstein 101. This is an accumulation stage 1 into a potential stage 2. We like this above 52. We nailed it today, 52. We expect a pullback. If you're not in TTI, high volume breakouts over horizontal channels on high RVol, this case 2.25. Within 1 to 3 days, we expect a throwback to $50. That's our entry. But we don't want to own ARK. Why would we want to own the ETF? Not a bad ETF to own, 2.8%. But what happens if we could do something a little better? You guys understand how stage theory and this market model makes sense, right? If you don't, I have so much content on YouTube about it. This is the most bullish time to be buying because this is how you can reasonably time a larger move off of a bottom. You don't have to buy down here. Everybody wants to. I wish I did too, but that's not the system that I run, and most people can't do that. You end up losing a lot of money trying to time the bottom. So instead, let's wait for it to base out and buy the new uptrend. This is the pivot point for ARK. 51.52. If we can nail it, this is the beginning of a potential new stage 2 uptrend. Who knows where it goes, but generally they go up near all-time highs eventually. Not saying it has to happen tomorrow. Let's go. Let's talk about this ARK idea really quick. You don't have to love Kathy, but you have to understand that if ARK is breaking out, what type of stocks are generally going to be breaking out? You understand ETFs move because of the constituents inside. It's not the other way around, right? The ETFs move because of what they're holding is moving. So if ARK is generally comprised of higher beta, low and mid cap names, some larges as well. Should we be looking at that specific area of the market, the ARK names, the shit stocks, the higher beta crap? We don't get to choose whether or not those are going to run or not, but we do get to choose whether or not we're going to take advantage of that opportunity. And I'll tell you right now, if you have an opportunity, well, we'll talk about it in a sec, about opportunity cost. Let's look at some of the names here going back 3 months on the return. Coinbase, Roblox, Twist, Path, Square, Roku. I mean, these are meme stocks. Everybody knows these things. Shopify. Over the last 3 months, these things have outperformed. Let's go to the 1 month. Check this out. Over the last month, Twist, Coin. I mean, these are just Robinhood. We just bought Robinhood today for the first time. We bought the dip on Robinhood. Let's pull that up really quick because this is exactly what I mean by these are the types of stocks that are running. It's the exact same setup as ARK. And if you can't tell, we trade a lot of the exact same setups because they work. There's no reason to reinvent the wheel. IPO, markdown, stage 1, stage 2, potentially. We like this above 1225. We gapped up over it today. We pulled back. We took the opportunity to get our first real long in on Hood. We don't know if this is going to play out yet because if the market does not confirm the ARK break, which, like I said, 1 to 3 days we'll know. We got a great ad if it does, and we're going to lose small if it doesn't. So this was an opportunity to buy cheaper contracts because, once again, if you don't know the basic concept, you should not be buying long on up days. You should be buying long on down days. Makes sense, right? You want cheaper contracts if you're an options trader, better entries if you're a stock trader, and conversely, you want to be going short on big up days. You just get better fills, better price points. Hood gapped up and over 1225, pulled back. We took advantage of it near $11.90 to $12. So like I said, we took our first crack. But these are the types of stocks that are within ARK. So if you expect ARK to be breaking out, which it certainly looks like it's trying to right now, go and look at some of the shitty stuff that most people are going to make fun of, but realize that it's just a trading vehicle. It's all you're doing. You're taking the stock and trying to pull price action off of it. Who gives a shit what stock it is? If this is the type of stuff that's moving, high beta, small and mid cap names, that's what we're going to be trading over the next 6 to 8 weeks. No Microsofts, no Amazons. We still have positions in those, but we're not going to add them. We're going to go buy the stuff that's fucking moving. So we have about 2 more charts to go through, but I want to take about 30 seconds to talk about this idea of opportunity cost. If you are not trading the higher beta names, which at the beginning of this presentation we looked through higher beta versus lower volatility. I proved to you that higher beta stocks are breaking out. We just looked at IWM breaking out above above $200 into a 2-year high. We just looked at ARK potentially breaking out into a stage 2. If you're not concentrating on the higher beta names, you are missing out. A great example, Costco. Every asshole is looking at Costco. Great setup. Fucking love it. This is a 2-year ascending triangle breakout into all-time highs. Who doesn't love this? This is a fantastic setup. Seriously. It's easy. A 5-year-old can finger paint this goddamn chart. I love it. You can define your risk very easily at 610. But from an opportunity cost standpoint, this is a 1.22 ADR, meaning on average, this thing moves 1.22% from peak to trough intraday. In a market that is rewarding high beta stocks, are you going to go and own a consumer staples name that moves less than 1% per day? Let me shift click on here really quick, because if you look at this, you're like, wow, it's a great trade. You're almost about a quarter way through to the price target. Good job. Over the last few sessions, we'll even take it to the top. We won't count closing price. This moved a whopping 5% as the market just hit new highs. Great. If you traded this, you probably have a winner. Good job. But are you going to make fun of the dickhead that bought something like a Sentinel-1 at a 4.83 ADR, which is a mid-cap software name that ran 18% over the same time frame, not counting the drawdown? Even with counting the drawdown, it outperformed Costco. The opportunity cost of locking your finite capital up into low beta stocks right now is going to cost you a lot of money in the long run. You have to be able to adapt to the market environment. Costco is probably going to be a winning trade. But when you look back on it, you're going to go, why the fuck did I trade Costco for a 20% move when shit stocks are moving 80% in the same time frame? The only problem is you at that point. Forget what stock you're trading, find the environment that you're in, and then go find the individual stocks that will allow you to capture the price target. We're in a bunch of these types of names, by the way, not just Sentinel-1. As a matter of fact, I don't know if TPG, here's a good one. Here's one that we're in. Obviously, this one's, I'm cherry picking here because it's fucking working great. So you don't like it, fuck off. But there we go. Fantastic, right? Like I said, higher beta stuff that's breaking out. Dash, a little bit slower mover, but once again, nice little breakout here. 86. This is up 17%. Hood is obviously one we're just entering. Birkenstock, who the fuck expected Birkenstock to do this? But look at the Birkenstock move off of the 42.48 pivot up 17%. Once again, you see what I'm talking about. Go and find the higher beta stocks. The opportunity cost of locking up your capital is just like those assholes that did it a year ago. Not saying it was the worst idea at the time, but locking your capital up for 5% for an entire year, you just missed 55% in the Qs. Good job. You made 5%, but you missed out on the additional 55 or the additional 50, I guess. Right? So think about that. Last two charts I want to talk about, just the Dow Jones Industrial. If you're old school, you understand how important this is. This is arguably the most important index in the market. If you're an old school trader, this was it. Reason why we like to use the Dow Jones inside of TTI is that the Dow Jones is not dominated by tech like SPY and the Qs. Qs obviously very dominated in tech, but SPY as well. SPY is about 25% of tech. The rest of the sectors make up the rest of the 75, but it's still tech dominated. The Dow is not. I think the largest sector right now in the Dow is financials, followed by industrials, healthcare, and then tech. So it's just a better, more equal weighted, if you will, way to view the market, and we're at all-time highs. So for those of us that celebrate the Dow, good job. Here we are. S&P 500 is going to take the cake when it's up there, but we're already there in the Dow Jones Industrial. So more fodder for you guys to go and look beyond the mega cap stocks, right? If financials and industrials and healthcare are pushing, there's a wide array of stocks that you could potentially be taking. And the last one, there's a couple other charts on here, but I really don't want to go through them just because it's already been over an hour here. We're going to talk the bond trade. So the dollar and the bond trade, everybody's talking about the dollar. If you don't know about the dollar, it has an inverse correlation to stocks and bonds right now. We've been trading that for the last 2 years. The dollar is dying. Use ticker DXY and go look at it. It looks like shit. That's great for stocks. If you expect new lows or any sort of significant pullback, it's because you expect a bounce back in the dollar. And today it's dead. Like we're very close to testing the $100 area into new lows. Bonds, we took a couple positions in bonds. The original 93.5, I don't remember, probably 93.5 here. Took a premature entry here on 93.5, held through the drawdown and averaged in. I didn't because I'm a dumbass, but most of the guys in TTI did. Bearish divergence, same thing we saw in SPY, right? Higher lows in the RSI, lower lows in bonds. We knew that they were eventually going to pop. We just didn't know when. Couple guys in TTI got filled in here and a couple other guys chased up, but here we are on the 200-day moving average gap up, right? For those of us that are not, including myself, positioned appropriately for these bonds, we have some guys like Dustin, if you're listening to this, good job. He's up 350% in a bond play. It's not something you normally see. He's one of these guys, but not everybody grabbed it. What I'm looking for, and I'm assuming what most of you guys are looking for, if you like this bond play, it's going to be a little bit slower of a mover, so buy a lot of time on this. Look to enter somewhere on a pullback to the 200-day moving average. That's my plan here. Right, so I have some $100 calls, I believe, that are still down after opening them back up in September. I'm probably going to be able to get out at break even or maybe a slight profit, but it was a bad trade. I'm looking to get back in with more time on a pullback to the 200-day moving average. Good opportunity to get long bonds with enough time. You don't need to worry about it too much. Obviously, don't look to risk more than you can lose, but if bonds are back, if bonds are going to bounce, there's a hell of a lot of real estate to make up to the north side, right? If you're buying off the 200-day moving average, a decent price target is that 105 area, previous resistance. Assume that there's going to be resistance up there as well because this is technical analysis and that's how you fucking trade, right? Any questions, feel free. Last chart as we're going to answer questions if you guys have any is Bitcoin. Hell of a fucking chart. If you're not long Bitcoin, I don't know what the hell you're doing, not to be an asshole, But everybody, even the old folks that aren't old folks, even the old folks that only trade the equities market, you can trade equities or you can trade Bitcoin through the equities market. The whole reason saying this is the Qs are up 55%, which is near a record-setting high for the year. BTC's up 158. So if you're still in the mindset that you don't want to trade this because it's a scam, totally fine if you don't believe in the long-term tech. But from a trading standpoint, you don't really have any reason not to trade this stuff when you have vehicles like Mara and Riot, trades that we're in, right? The Mara trade right now, we have one guy up 1,000. Most of us are up in between 300 and 400. Mara, new highs today, right? Very high correlation to BTC. Riot, the one that I'm in that's underperforming, imagine that. Also high correlation to Bitcoin. Go and trade these names if you like the BTC chart but don't want direct BTC exposure. As a matter of fact, I have a video on this on YouTube. Trading these miners results in better moves than trading Bitcoin. It's almost like trading it on leverage because you just saw BTC from the low is up 150%. Riot is up 379%. Mara is up from the lows 473%, and they are generally correlated to Bitcoin's underlying price. So if Bitcoin's going up, is it reasonable to assume these BTC miners are going up? Yeah, as long as the correlation holds it is, and you're getting outlandish fucking rewards for trading these. So there's another light bulb for you guys. All right, we're going to run through two charts here, Docs and PayPal, and then I'm going to call it a night. I appreciate you for sitting around and listening to me fucking yap. And hopefully I sparked some interest in some new ideas. IWM, high beta shit stocks. This is kind of the time to go look at them. If you're following me on Twitter, at How to Swing Trade, I post scans all the time, post trade ideas. Feel free to follow me there. I'll post a scan setting after this for you to go and look for them yourself, which we're doing. So Docs here is generally not something that I would like to be buying. It's a software mid-cap name, 4.92 off a 2.99 ADR. It's not the worst setup in the world. Island reversal fractal. I see what you're looking at here. It's a little rounded bottom. All you got to do on something like this is draw some fibs. But what I'd be looking for first is a move up and over the 200-day moving average. So general rule of thought here. I mentioned this earlier today. Paul Tudor Jones. Listen, you got to learn from the guys that are the greatest. Paul Tudor Jones says, don't buy shit under the 200-day moving average. It generally doesn't work as well as the names that are already above it. I take that to heart. So I would wait for something like Docs to be above the 200-day moving average. And to be honest, there's better software names right now to be owning that are already in uptrends. So this is a difference between TTI and other groups. Other groups will look for just a setup like that. We're building the entire picture and looking for strength first. The setup is almost the last thing we look at, and the setup is just to define risk. So we want market strength first, and Docs is not showing it yet. PayPal is going to be another one of those names that is not showing it yet. Eventually, PayPal is going to catch a bit, but this is not something we want to own. As a matter of fact, I think Square is outperforming PayPal, right? Look at that. Why would you own PayPal over Square at this point? Square is very clearly the winner, and they're within the same space. As a matter of fact, PayPal against Square is probably a downtrend. There we go. You don't want to own PayPal. Own the better of the two. It's the same idea as this. Uber had this question. I posted it on Twitter. So we bought the Uber play. I think most of you guys are probably in it if you're on the newsletter or follow my Twitter. We bought the March 60s back at the 48.5 pivot. Huge win for us, right? Spot's up 30% to all-time highs. These contracts are up like 400 to 500%. Fucking nailed it. High fives all around. So the question here is, do you want to open new Uber plays up at 64? All right, if you want to get long Uber, do you use 64 as a new risk, or do you go and buy Lyft? All right, Lyft is giving us kind of the same sort of setup as Docs, except we're above the 200-day moving average, a little bit of an island reversal fractal. Most people would probably say Lyft because they think, at least, that owning names that are down have more room to run. We call them catch-up trades, right? So if we were to buy Lyft here, we would assume that it's eventually going to catch up to Uber. There's more room to run. But what happens if I asked you this rhetorical question? There's a reason why the market hasn't bought Lyft. What's going to stop the market from buying the clear market leader with Uber and instead buy Lyft? That's why it's stuff like this, Uber against Lyft, is so goddamn important. Since April of 2022, the market has wanted Uber more than Lyft, so we're going to continue to run with that. In our minds, there's no more bullish opportunity to buy a stock than at all-time highs. It's there for a reason. And so take that to heart, right? Docs, PayPal against Square. Once again, Square is the better of the two. So if you wanted to own one of those, I think I'd be looking at Square there. Okay, guys, my name is Hamilton. You can email me at hamiltondrips@thetradinginitiative.com if you have any questions. Also, if you're on Twitter, go ahead and pimp out the tweets here. Feel free to follow at How to Swing Trade. You can see everything that I'm talking about in here. I randomly post it throughout the day. A lot of trade ideas, updates on trades that we're in. So if you're following them, obviously you can get updated on whether or not we're still in them. I also answer DMs occasionally, as long as you're not asking for free shit. I will help you out a little bit if you ask me a question. Good stuff on the Twitter. It's a great way to talk to me. YouTube is just harder to talk with, right? So I appreciate you spending your Thursday night with me. Hopefully this prepared you for the next 6 to 8 weeks.